Thank you so much for taking the time to go through my Futures to Funded course. I promise I will not disappoint you. This will be well worth your time and will teach you strategies that will generally help you be a better trader and more consistent and reach your goals. But my goal for you is to help you understand futures. And for those people that don't have a lot of money, I want you to use the prop firms to get funded to help you quit your job and become full-time even sooner. So this is for people that have less than $500 in their account or multiple six figures. Futures trading offers major advantages over options, stocks, and cryptocurrencies that makes it hugely unbeatable for some people that want to get in and out of the markets with leverage and liquidity. But I mainly made this course because I get so many messages every single day, every single week of people that don't have money, they don't really have a lot of time, but they want to quit their jobs. And it sounds like the impossible, but with what I'm going to teach you inside this course, it might be way more possible. So I want to help out all those people because I was in your shoes too. I was working in college, multiple internships at engineering firms, and it just felt like I didn't have a purpose. Like it didn't feel fulfilling, and I couldn't imagine waking up and doing that every single day. So after college, I did not want to work a job, didn't want to work anything in the engineering field at all. I was actually a pretty good runner in college. I was ranked first in the nation for some periods of time, and out of college I decided to go professional. So professional running, and I decided to, on the way of trying to make the Olympic trials, just to always pick up new skills and keep learning. And then one day I got super injured. I had about 6 months of downtime, and I didn't have a full-time job, so I had all this free time, so I ended up trading the stock market. And this was perfect because I wasn't sponsored by any team, any shoe company, so no one's paying for my travel, my massages, my weightlifting. That's all on me. So my whole career when I was professionally running, I was just like, how do I make money to even just sustain pro running, or even when I get out of this, feed my family, like take care of everybody. So trading was the one thing that finally hit for me. I tried everything, tried drop shipping, tried photography, I tried making apps, making products, and it just didn't work. But the first day of trading, I made $50 and I was like, this is it. I'm going to do this for the rest of my life. And I loved it. Like the challenges of the market kept me going. But on that journey, in the beginning, I was mostly like everybody probably watching this video, less than $500 in a trade, less than a couple grand in their account, and trying to make all these big things happen. I wanted to, buy a house. I wanted to pay for my lifestyle as a pro athlete, and then eventually not have to work ever again. So I was trying to do that with a very limited budget of a couple thousand. And I did the same thing most people do. They go straight to options because it has the most leverage, but then you are trading 0-day options and it has the most amount of decay, and it's almost impossible to win. So futures trading doesn't have that, which is amazing. But when I was my first year trading, just always trading 0-day options around Thursday, Friday, some days, and I would try to just hit 30, 50, 100%, and I would never have a stop loss sometimes. And no matter how high my account got, it would just get wrecked in a couple of trades. And so when I was starting out trading with just a couple thousand, I always hit roadblocks. Like if I doubled my account, that was like a roadblock. And then 3K, I hit PDT, and then PDT was a roadblock. And then 3K to 50K, and then 50K was a roadblock. So I went through all the struggles that most traders do. And that's why you're here learning from me, so you can learn from my struggles. But that's about 3-4 years ago, and I turned 3K, multiple times to 25K, but I've grown portfolios over this time to almost multiple millions. So I've started out from the trenches, and now I'm in a place where I don't need to aggressively trade 0 days. I don't need to aggressively do anything. So I've been through the whole spectrum, but the futures aspect really intrigued me because recently I was on a podcast with Jesse Casper Trading, who's a funded futures trader. And when he said that, I was like, that's not real. Like, there's no way you're trading other people's money and making a living from that. But he's like, yeah, I do. So he has like multiple six figures. He gets payouts every week. And I'm like curious how we can do that, because if you pay a prop firm, it's $100 and they'll give you $100,000. Like, that didn't add up in my mind. So from a competitive standpoint, I wanted to get funded and get paid out just to see if I could do it and see if I could kind of compete with the other funded guys out there. So that's what I did over the last 2-3 months. I just learned as much as I could in the funded space, in the futures space. And so what I did is got funded in 5-7 days on one account. And then I actually traded well enough on that live account to get paid out in another 7 days. So that's why this course is called Futures to Funded in 15 days. It's because that's what I did. So if I'm doing it and I'm teaching it, I'm hoping you can replicate it, because that would be ideal. So maybe I'm setting up a false promise in your mind, but I truly believe you can be funded and paid out in 15 days if you follow this course correctly, and if you're patient, follow the trades correctly, and follow the strategy I'm going to release at the end. The whole point of this whole process of what I did in the future space is just to prove out the concept that you can get funded and paid. There's no gotchas, there's no fake walls that you have to jump through. This is legitimate, and we're going to be using Top Step in this course when we talk about the examples. So when I started out trading, this would have been a great way to get started. If with my first $3,000 account, I could have basically used 10 to 20 evaluation prop firm accounts and unlocked maybe 6 figures of capital. So I might have been way profitable, way quicker on this route. And I'm hoping that when we go through this course and we teach you everything you need to know, that you unlock something in your mind that sees what's possible out there. I don't want you to think that this is a scam and prop firms are just not real, that they're like unicorns, that they can't pay people out. They actually do, and this stuff is legitimate. So I wanted to break some barriers for you, some mental barriers, open up some opportunities. And if there are a few successful stories from this, please share it with me. I would love to see people that get funded from this course for free. So this is truly for those people with less than $500, because I know getting to a place of quitting your job is near impossible with less than $1,000 in your account. So this is the one solution I've found for those people, and I truly hope this course helps you out. Let's dive right into it. All right, let's go over everything about the futures contracts so you can have a better understanding when you start trading in them, what they are, and the risks associated. So we'll go over their settlements. What does that even mean? The risk of futures, the leverage, and the products you can trade. So number one, this is a leveraged product, only because every month the futures contracts are going to expire, and then that next month the new contract comes out. So it's just like options. Options expire, and typically when options expire, you have the buyers and the sellers. They have the ability to exercise the options. So options allow people to buy 100 shares of SPY or Apple or Triple Q. So as the buyer, you have the right to exercise your contracts. And as the seller of an option, you have no decision in the matter. If someone exercises the other end and you're short the contracts they exercised, you have to come up with 100 shares of gold, ETF, or SPY, or Apple, or could even be NVIDIA. So the point is that leverage allows people to exercise. But that isn't the reason people trade options, right? People trade options because the leverage allows them to make a lot of money in a minute or 10 minutes or a swing trade for a day or maybe even hold for a couple of years. Options that leverage is the tradable opportunity, but it also comes with risks. So futures have advantages over options that we're going to get into. But I really want to point out the fact that the settlement allows the opportunity for this leveraged trade to make $1,000 in a minute or $2,000 in a day. So with futures, the only difference is if you're exercising a futures contract, you are giving hard assets sometimes. So you could be putting gold out there and selling somebody gold at a certain price, and they're buying it at a certain price you agreed upon when you bought your futures contract. Or you could be doing index funds. You can have those index funds be settled and you end up buying index funds. It could be coffee beans, it could be oil. So it's a different type of settlement that is actually pretty interesting if you think about it. So it's the same thing that works with options. There's the buyer and the seller. They agree on a price. The price is the price they buy the futures contract on. And the reason they're called futures is because you can buy or sell these assets in the future at that price. So let me show you exactly what we're talking about. So the number one reason futures were made is to mitigate the risk of like companies that maybe buy too many coffee beans or buy too much jet fuel, or maybe hedge funds, they want to protect their position. It could allow them to hedge. So this is coffee futures, and you can see coffee beans ran almost doubled in price in this 12-month period. So what you could have done is go to the coffee bean futures, let's say your Starbucks, and you could have said, hey, I know coffee beans increase in price every summer. I'm going to go ahead and lock in coffee beans today to buy them in the summer at this price. Let's say it was $130. So this is the futures chart, but every single candle, people are actually buying these contracts that they can buy the product in the future for. Like if you're a company, this actually becomes something that you would integrate into your business. So if they bought these contracts here, let's say they're 3-month out contracts or 2, you can pick up those coffee beans at this price in the future. And so this allows you to avoid buying them for double the price up here. So it saved that business, helped them manage their risk of running the business and not knowing where prices are going to be. Lock in something that they know where it's going to be today and not have the uncertainty in the future. This goes the same for if you shorted those contracts. So if you bought them, it gives you the ability to buy that coffee beans in the future. And yes, people will give you the coffee beans of the other contracts typically. And so if you shorted, and that would allow you to sell coffee beans at that price. So let's say the reverse example is we ran up to $230 for the price of these futures contracts. You could sell contracts for 3 months out, and then that would allow you to sell the coffee beans for that inflated price. And that allows you to make a premium because they were very inflated there. And let's say you didn't have the coffee beans at the moment, or maybe you didn't want to sell them right then and there. You knew you were going to sell them. Well, you could lock in that price to sell in the future with the futures contract. So if I go to coffee beans, you can see here they have every single month, most months for expiration. So September, December, March, May, July. And you can see the price of the contracts goes up because it's just like an option. You have the leverage and the time aspect. So there's a certain decay that happens from holding these contracts, and that's why the future contracts cost more, because why not just lock in coffee beans 10 years out at this very cheap price if it was there? Well, the only reason you wouldn't do that is maybe because the 10-year out contracts cost too much. You can see the 165s are expiring next month, And if you locked in prices 3 years from now, you're paying almost 7% increase. So you're paying a premium to lock in the future, but it's just a matter of, can you beat the premium? Yeah, can you buy the coffee beans still cheaper despite that 7% increase? That's, as a business owner, the risk management, everything you would check. So in terms of the actual contract and the details, it's very important to understand how this could be exercised and how this looks to you as the trader. So these are all the details of what futures are and how they move. So first thing, we have your symbol. Your tick size is going to be 5 cents. And this is important. So when people say ticks with futures, it basically is just talking about that nominal value and how much money you make on your contract when it increases that amount in the markets. So every 5 cents for coffee beans will make you $18.75 per futures contract. That's the most important part when you're trading these assets. If you're analyzing your risk to reward and figuring out how many contracts you should buy, you have to see how much the tick is and how much you can make per tick. So you can see the next column, margin maintenance. This is extremely, extremely, extremely important because this is how much money you need to be locked up to have one contract. So coffee beans, if you had a coffee bean contract, it costs $7,425 of margin. So this is not the cost of the contract. This is how much they just want to protect themselves as the brokerage if you buy a contract. And so the maintenance value, that's the lowest amount it can go down. And then you have down here, contract size. This is how much actual coffee beans you're controlling per contract. So it's 37,500 pounds, approximately 250 bags of coffee beans. Isn't that wild that you can buy this contract, exercise it, and get 250 bags of coffee beans? It's insane. So we have the months it's trading, the hours it's trading, and then down there, I'll move my face. That's how much you make per dollar. So $375 per dollar move in that futures contract. So let's talk about this again. So like we talked about, when you manage the risk in your business, if you're buying too many coffee beans, you'd be locking in prices to sell in the future up here, locking in prices to buy in the future down here. As a business, that's how you would do it. But if you want to trade this is the exciting part. So the leverage component is why people get into futures. You could take $5,000, and I've seen people turn $5,000 into 100,000. I've seen that same thing happen with options, but options versus futures, there's a big difference between them, which we'll talk about later. But the one contract will require margin. You need margin for futures. So $7,425 is the margin required. Every dollar it ticks up, the futures contracts will make you $375. You also control, again, 37,500 pounds of coffee beans, which is wild. It's just amazing to think you could actually exercise it and get coffee beans. So in terms of what does this look like in a swing trade, if you held a year-out contract, you were long, you were just trading, you don't care about exercising, you could turn your $7,000 into $55,000 of profit, because 155 points times 375, and I'll show you that in the calculator. 155 times 375 is actually 58,000. I might have missed it a little bit, but the point is, it's a lot compared to the cost of the margin it locks up. You could basically get close to 10xing your money with the right trade in the right market, just in a swing trade for holding it for a period of time like this. So leverage is insane. So almost 10xing your money in a year. So 7% in a year is insane. Most people want to get that when they're investing their money. 10xing is just as incredible. So here we see a 7-point move just intraday. Like if you were scalping this, if you were holding this for 4 hours, 2 hours, 7 points, you make $2,800, which is a 50% return on your margin. So if you had a $10,000 account, you'd make like 28% return on it, which is pretty incredible. So that return for this move in just a scalp trade or a day trade is the reason people flock to futures. So you're probably wondering, what can you trade? And so you could trade pretty much everything you would typically trade in the markets. So you have the SPY, the triple Qs, the Dow Jones, and the VIX, the 10-year, crude oil, natural gas, gold, silver, coin, wheat, soybean, sugar, coffee, plethora of many more. You can trade foreign markets, you can trade currencies. Futures are incredible. So that's the options, and that's a quick overview on futures. Now let's talk about the beauty of futures. Why would people choose this over options, crypto, stocks, and everything else out there? We have no PDT. You can use prop money. It's very liquid. It's very leveraged. There's many more hours to trade it, and there's no decay. That's a short overview. Let's dive into the details of what this means. So pattern day trading restriction. This is where if you have less than 25,000, if you're on a margin account, you get into a trade, you can't get out some days. And it's very frustrating. Once I was hitting $3,000 to 12 in one day, I 4x my account, and I could not exit the trade without locking myself out for the next 90 days due to the PDT restriction. So I was under 25K and I had a huge day, and this is very frustrating. This is what happens to new traders all the time. Inside our trading group, people will be up in a trade, they end up bag holding, and it turns into a massive loser. So the PDT limit is really harmful to traders. It has its benefits, it has its limits, but that's not the case with futures. So futures does not have a day trade when you get in and out. So this is because it's on the NFA. It's regulated by that different agency or company or whatever. And so you don't have that restriction. You can trade as much as you want with futures. You can be under 25,000 and you can be in and out on this stuff. So the only thing that's going to be harmful is the commissions. So the more you trade, the more commissions you pay. So that can really damper on your profits in your account. But other than that, there's no day trading limit and you can be under 25K. You just need a margin account. Other benefit is you don't even have to put your money into a futures trading account. What you can do is use prop money. And so we like Top Step. Top Step is verified, pays people out. It's very easy to get funded. And this is where you would get on like a monthly plan. Could be $50, 100, or 150. And your goal is to hit the profit target. And once you do hit the profit target, they unlock that amount of money for you. It's called prop money. So this is where you pay a lot less. You trade futures with different platforms, and then you trade with their money if you hit the profit target on these, what they call evaluation accounts. So if you want to trade futures, one of the coolest things is you don't even have to trade it with your money, which is great for beginning traders because you're going to blow up a couple accounts. It's going to take years to be profitable. You're going to struggle. This is the path of every single trader. For me personally, I blew up a $3,000 account once, twice, 3 times. And the 4th time I turned 3K into almost 30K. So it took multiple years. It was very frustrating. You don't need to go on that path of blowing up like I did $10,000. If you put $100 in a prop firm account, you pass their challenge, you could be making $1,000, $10,000, $100,000 just off that first $100 investment. So the prop stuff is very powerful if you can trade within this system that they put in place. So just to give you a quick reference, I bought a prop firm account. In 7 days I got funded, and then in 7 days I got paid out. So 15 total days from me buying their monthly membership thing to me getting my first $1,000 payout. So I just say that because how many people have $1,000 in their trading account? More importantly, how many people do you know started trading, took out $1,000, put it in their bank as profits? I mean, it's a better path for new traders, and the futures aspect is associated with it. So that's how we trade on these accounts. Now let's dive into the liquidity. I'll take off my face for this point. Liquidity is the buyers and sellers. It's how easy it is to get into the trade without losing a lot of money. So there's slippage, there's liquidity, and this is very tight with futures. So we can see here, if you were to enter this futures trade, this is the ES futures. If you bought one contract, it costs 11 grand. The tick value is 1250. So a tick is going to be, you can see these here quarter ticks here. So every tick up is 1250. So meaning if you enter the trade, typically the way you look at liquidity is if you had to enter instantly, you would hit market order. And the market order goes to buy where the sellers are. So this would be the 825 level. So if you bought, you'd be in the trade at 825. The way I look at slippage and liquidity is if I had to exit that trade I just entered instantly, I would sell at market. And so if I sold that same trade, it would go down to where the buyers are, the first set of buyers, which is at 775. So that is a two ticks of slippage. So you're losing $25 on an $11,000 margin hold on your account, which is really not a lot of money. So it's 0.1%. So you're not losing much getting in and out quickly, just hitting market order, market order, market order, market order. And so if we look at over here, if you were an options trader, you would have a $75 option, as you can see here, and the buyers are at 74, the sellers are at 75. So the slippage is $1. $1 doesn't seem like a lot, but $1 on $75 is a lot. So the slippage is now 1%, because if you enter this trade, you're theoretically market order, enter at 75, and then if you exit this trade, market order, exit at 74. So that's $1 you'd be losing on your trade. So if you had 100 contracts, you lose $100 instantly getting in and out. And that slippage over time really kills traders. So that is the death of options, and that's the huge difference that makes futures way better for new traders, way better for anybody who's just trying to get in at a very precise places. And I can show you an example for that in a second. But the other point is the leverage per dollar move. So this is where if the futures contracts goes up, how much do you make on your margin, the amount of money tied together? So you can see here, if you have $11,000 of margin, it goes up $1, the market goes up $1, you make 50 bucks on futures. That's how it works per tick. So the tick is going to be a quarter, and then the dollar move is 50 bucks. If the stock market goes up $1, your option could go up 40%. So the only downside of futures is it's not as leveraged and degenerate as options. You know, you're not going to see 1,000%ers. You could see 50%. You could see 20% in a day with futures, but that's a good day. And a good day for options for me is 20%. So not a good day, but a good trade. So if I'm looking to trade like a 5-minute trade for options, 20% is good, but like 100% is what I typically try to hit. So for futures, you're not hitting 100%. Like your best day is going to be 20% on your account if you're great. And so options pay a lot more. But the downside is that decay, which we'll talk about. So the other opportunity for futures is the times that they trade. So futures can be trading Sunday night. They open up at 4 MST. And you could be trading futures on Sunday when they open. And you could be making money more times of the day, more days of the week. And it allows you that opportunity to trade when you couldn't with options or with stock. And so, for example, I'll show you NVIDIA just had earnings. And NVIDIA earnings rocketed. Stock rocketed. And everything was pumping. All the indexes were pumping. So if you saw this, unless you're trading stock, you're not taking advantage of this move. This NVIDIA move, you're probably only watching it if you're trading options. But if you are trading futures, you could be trading the triple Qs, the SPY with futures, and then that you could be trading these after hours, taking advantage of this volatility. If you were bullish on NVIDIA beating earnings, futures could have paid you a lot of money. So if I go check out the NQ here, and we see a pretty big fall, but you can see futures when NVIDIA posted their earnings pumped, and then they just ripped for the next couple hours overnight. So you're looking at like 1 a.m., 2 a.m., 3 a.m. So you could be trading all of those hours. And so again, this move here is 10 points is $200, I believe. So we see this being 15,300 all the way up to 15,400. So that's a 100-point move, $2,000 a contract. If you had 10 contracts, this is $20,000 right here. $20,000 on that move for 10 contracts with the NQ. Point is, more times of trading, they're a great thing. They're also a bad thing. This is my downfall, honestly, is because I can't pull myself away from the computer. So if the stock market is still open and trading at 2 a.m., I'm likely to be up at 2 a.m. So futures is not for me to trade full time because of that fact. And it's going to be tough for other people to hold themselves back and control themselves. So that's the only downside to more days, more hours to trade. So be aware of that. That's not going to be great if you can't limit the days and times you trade. So the other thing I want to point out is decay, which we all know. Futures don't decay. If you hold them for months, if you hold them for multiple months, yes, they can decay. Like I showed you earlier, the monthly contracts for futures, they go up in price every month. So if you hold these futures for a long time, you're paying a premium for that. So the long-term effect is you do have decay, but for a 10-day period or a 5-day or even a 5-minute trade, you're not having that decay. So futures, that's the benefit over options. If you're buying an option, I've seen options just a week out till expiration lose 2-3% in value. And I can show you this example here to paint the picture better. And this is a huge benefit if you're trading and scalping the market. You don't want decay, especially in a 5-minute period or a 10-minute period, because it could hit and make your stop loss come into play a lot quicker. So if you had NVIDIA, and these are 1 day out till expiration, let's take this and drag this down. And this is a cool site for analyzing options, but you can see right here, NVIDIA, if it goes 20 minutes sideways tomorrow, you're losing 1% almost. So 1% loss, 20 minutes of holding. Another 20 minutes of holding, you're losing 2%-ish. So another hour, 2.5%. Doesn't seem like a lot, but it can add up. And if the stock is going against you, that decay can help have it hit your stop loss a lot quicker. So it could really hurt you if you're in a very tight trade that doesn't have a lot of room to run. And you can see if you go a week out, even a week out, if you're holding the trade throughout the day, let's say it's at break even. Let's make this go down one more. So this trade's at break even, 0.1%. I'll drag this over. So the trade's at break even. If you held the trade the whole day, you would lose 1.6%. Just holding a week out contract on NVIDIA. So that is kind of a big example, but some people are using 0-day options, and those decay sometimes by the second, and they're so deadly. So that decay does not happen with futures. You can be very tight on how you get in and out, and you don't have to worry about any other factors affecting the trade. You have the price you get in and the price you get out, and that's that. And between those prices, nothing much more happens. So there'll be volume, there'll be movement, but you're not going to have an early stop out from other factors that are associated with options. So that's why we like futures. That's the benefits of them. Hopefully you understand why they could help you as a new trader, and more importantly, how you can use them to offset even more risk with prop money. So at the end of the course, we'll go over the best platforms to get started on, how to set them up, the best tools to use to be fully ready to get funded and get consistent payouts with prop money. Now, this is probably why you're here, to figure out how to get funded. Can you really trade with other people's money? And is it possible to get paid out from these places? So I didn't believe it was possible. It seemed like a myth, a fairy tale. So I popped on a podcast one day with Casper, Jesse, and he's been a funded trader for almost a year, getting consistent payouts. So that opened my eyes on what's possible out there, because you pay $100, $50 for your first month, and then if you get funded, you don't have to pay that monthly fee, and then they give you capital. So I did that, and I got the capital, and it seemed too good to be true. But then I followed the rules, I traded correctly, and then they paid me out. Money hit my bank account once I jumped through their hoops and hit that 5-day trading threshold on Top Step. I hit $1,000 payout in my account. So the reason I tell you this is because most people, again, don't have $1,000 in their trading account. They might have $500. So how could you take $500 and get a grand payout? It's gonna likely blow up your account with any trades you do, penny stocks or options. So taking $500 to $1,500, it will not be very possible for new traders. So this is kind of like a sweet solution, a huge opportunity if you want to learn how to trade, save money, not be blowing money, your own money, your large earned money every single month, week, year in the markets, just to pick up these lessons. And more importantly, you could be getting way bigger payouts than would ever be possible with a measly $1,000 or $500 account. So it has the potential to even create full-time traders much quicker, replace your income much quicker because of that funding aspect. So we'll talk about what are prop firms, the process of getting funded. I'll walk you step by step on Top Step, how to get funded, and then the last part is the payouts. And like I said, I went through this whole process with Top Step. It was smooth, it was efficient, they paid me out, it was no struggle, and I got my first $1,000 with them, only spending like $150. So prop firms, they offer all of these things for you: capital allocation, profit sharing, risk management, tools and platforms, and training and support. And this is huge. So number one, the best part is capital allocation. Like, they give you $50K, $100K, or $150K. So what happens is you have to trade on a paper account, hit the profit target, whether it's 3K, 6K, 9K. You hit that, they unlock the money. Simple as that. Very next day, boom, it's yours. What happens next is you make money in that account. For Top Step, that first $10,000 is yours, 100% of it, and then you share the profits after that. So it's a 90-10 split in your favor. So it doesn't even seem that bad. Let's say you make $50,000. You keep 90K of that, 90% of that, so 45,000. That's not a bad deal. They keep 5, works out. And the best part is they have these systems in place to help you learn risk management. So as a trader, the number one reason traders fail is because no stop loss. They get in a trade, they have no idea what their downside is. They're trading with their own money. They don't have a limit down where they just stop trading for the day. They stop trading forever. They save their money. Most of the time we see traders put in all their money into one trade, either a revenge trade or they're just not that educated, and their account goes bust in one trade. So they have risk management on these platforms in place so you don't hit that much for a loss. This means you have a max drawdown on the whole account for the most point. That would be on like a 150K account, you can't lose more than $4,500. So if you lose that, that's breaking a rule, and then you lose the account. So you don't want to break the rules or else you're going to lose the account. And that's a huge rule they don't want you to break, is don't hit ever the max drawdown. And then some platforms will offer an intraday max drawdown. So this helps protect you to not lose the account. For Top Step, I like what they do. They have a $3,000 intraday drawdown. If you lose three grand, they lock your account for the day. This helps you take a break, walk away, stop over trading. Why is this good? Because the max drawdown is $4,500. This allows you to get stopped out and not lose your account, wake up the next day, you have an extra $1,500 of wiggle room to keep trading and hopefully not hit that drawdown, the max drawdown, and lose the account. So the intraday drawdown is a very unique aspect that Top Step offers that many platforms do not. And this really helps save your account and save the traders. Some platforms will have a trailing max drawdown where the number will go up with you, and Top Step does. So this 4,500 trails higher. So if you make, let's say 155, let's say this account goes to 155K, you make 5K, your drawdown goes up with it. So instead, you can't let the account go down to 1,400, 149.50, because that would be where the max trailing drawdown rose to. But if you started trading today on the highest account, you can't let it go beneath 144.50. So if it goes 145.50, yeah, if it goes beneath that, that's where you lose the account. But that trails up as you make money. And then lastly, the other form of risk management they put in some platforms is contract sizing. So I'll talk about this in a second, but when I did get funded, some accounts you can use 15 contracts, 10 contracts, 5. But when you do get funded, you can't use all of those contracts right away. You have to make money, and then every time your account goes up, it unlocks more contracts you can use, kind of like a video game. And if you want to use the full 15 contracts, I think you have to be over like 2 times your max loss limit. So this risk management is just stuff that should be known and should be implemented for new traders, and it's not being implemented. So these platforms, they want you to succeed. They want you to learn the right things. And I think this is a huge advantage for the prop firms and for you as a trader. It's going to help you in the long run. Just knowing what a max drawdown is, knowing that there is a limit that you should be done with after you lose for the day. Knowing that you shouldn't be using full contracts all the time. You should be using maybe only 2 contracts as a beginning trader, or 3 or 1. So it teaches you good aspects that would take a while to pick up, because most people just hate managing their downside. So the other thing they offer is trading tools. Every platform you see here, Bookmap, NinjaTrader, Quant Tower, these allow you to trade. So they take your data. TopStep takes the data from the platforms, you trade on them, and then it just shows how you did for the day on TopStep. So TopStep doesn't execute trades, these platforms do. And for the most part, you're just trading on sim or simulated platforms, simulated trading, and you're not putting in actual money. You're not actually trading futures. You're just doing sim accounts most of the time. So if you trade well enough on your live account, they'll put you in a live account. Or if you trade on your funded account well enough, they'll put you in a live funded account. So even if when you get funded, they're still not placing your orders in the market. Other great thing about prop firms is they want you to succeed. Like I said, they have a huge resource base. So TopStep has videos, podcasts, and blogs. Again, they want you to succeed. They don't want you to keep blowing money every month. So they also offer coaching. So they have free coaching. They have monthly coaching. I think some one-on-one coaching. They have Discord, a full Discord for futures traders. So these calls happen all the time. You can learn. You can hang out with other traders trying to get funded. They've integrated a lot into their systems to help you succeed. So I do like that aspect about the prop firms a lot. So that is what are prop firms. Now we'll be talking about getting funded. The most important part, how do you get this money? Because there's a couple hoops you need to understand. Number 1, the profit target hoop. You need to hit that. Number 1, and that only is the most important. If you don't hit the profit target, they won't even consider you to get the money. Some platforms have what they call minimum trading days. So you can't trade one day and get funded. You typically need to be trading like 2 to 7 to even 15 days to see if you can be consistent. And sometimes they'll implement what they call a consistency target. So you can't make all your money in one day. So that wouldn't make sense because you'd be basically gambling, just trying to get funded. But if you could make the same amount of money for 3 days, 4 days, or 5 days back to back, or even within a 10-day period, if you made $3,000 in 5 separate days in a 10-day window, it shows consistency for the platform, and some platforms will require that consistency. And then you have to avoid breaking the rules. And so TopStep has one rule: do not hit your max loss. So you can see here's an example of what TopStep looks like. I hit that. I had 150K for this account. I hit my goal. I had to hit 159K, and I went $2,000 over that just for funsie, and had a lot of great days. I think I went up like $3,000 every day, and I had one. My first day was down $3,000, and from there I went up $3,000 multiple days in a row. And you can see here my objectives are hit $9,000, which I did. My best day cannot be greater than half of my target. So if my target's $9,000 of profits, I can't have more than 50% gains in one single day. This is a consistency target. This is what most platforms will make you do. So if I made $7,000 in a day, they wouldn't allow me to get funded. I'd have to keep trading, which would be very tough because you'd have to hit like $20,000 of gains instead of 9 if you make too much money. So it's almost better to lose money if you go over 4,500. But the beauty of TopStep is you can get funded in 2 days because you just need to be within the 50% target. So every day you can't exceed 50. So you could have 4,500 on the nose. The next day, 4,500 on the nose. 2 days, you get funded money. It seems, again, too good to be true. Lastly, this is not a rule. It does not make you lose your account, but Top step, if you lose $3,000 in one day, you get deactivated. I did get deactivated on this. I didn't lose my account because my drawdown was another $1,500 lower. And then from there, I've just made money day after day. So even if you do get that deactivation, you still have a very good chance of getting funded. So don't give up, don't get down on yourself. And then eventually you unlock the funding. So you meet all those criterias, jump through all those hoops, you get funded. So that happened. I got the certificate. It's kind of a cool feeling. Now, lastly, we just want to talk about the payouts. So getting paid out is the reason you're here, the reason you're going to quit your job, the reason you're going to possibly become financially free from futures and trading. So this is most important to understand. So we have profit target. Just like getting funded, you have your profit target, your minimum days needed, sometimes a consistency target. You can't break rules. You have to check the payout threshold because there's some rules around that. There's some things you have to notice. And then you have to also watch your drawdown. So your drawdown after the payout is going to get affected. And I'll show you how. So here's my Express account. This is the funded one. This account hit $7,000, which is incredible. I hit $7,000 of gains with money that I could actually take out, which is really awesome. I had a couple bad days back to back to back. And it was kind of annoying, honestly. And so what I did is I had day one, the most impressive, incredible day in the markets. Like it was the easiest to trade. I hit $7,000 on the first day. So all I needed to do is follow their rules, jump through their hoops to get the payout. And so their hoops are this. You have to have 5 winning days. That's all I needed. All I needed to do is hit 5 winning days of $200. And I wasn't even trying to make money on this account. I wasn't trying to hit $1,000, $10,000 days. I just wanted to get my payout because it was, at this point should have been half of that because you can only take out half. So I wanted my $3,500, but I kept trading and I wasn't making money. And then I kept over trading, trying to hit this $200 like measly profit target. And the fact that they kept making me try to hit it made me lose money. And that was the downside of, for me, like this funded account, is I had to hit this target and trade during times I didn't want to, trade days I didn't want to, because I was kind of rushing this to happen. So the key is patience. And if I had patience, I would have probably made more in this account for sure. But you can see I hit my 5 days. You can also, that same $3,000 loss limit applies. You can hit that and still get paid out. And then you have that scaling plan. So you start with 3 contracts. If you make money, you go to 4, 5, 6, 7, 8, 9, 10, all the way to 15. So eventually you unlock the full leverage if you want it. But you shouldn't try to hit 15 contracts in any trade, honestly. That's why they have the scaling plan. And the other rule is do not hit the max drawdown. So $4,500 of losses, don't hit that or else you lose the account. Luckily, I didn't hit it, but I did get funded. So I want to talk about exactly how this affected my trailing drawdown and how it affected that amount I could lose the next day. So basically, once you take out money on your funded account, your trailing stop loss goes to 0. So if the account's at, for me, it was like at $2,000 when I started to take out money. What I did is you take out half. You can only take out half on Top Step, especially if you're in your first like 10 to 30 things, 10 to 30 days profitable. So I took out half the money. So that's like $900, let's say. So my account's at 1,000. I can't let it go to 0. So instead of a $4,000 drawdown, I have a $1,000 drawdown, which is very tight for futures. You have to be very very on point with your trading for that. So once I took out that money, that affected my drawdown. I was trading a lot differently, and I could not get the next payout because of that. So you have to be very careful how much money you take out, because it could leave you with no wiggle room to have a bad trade. And that was one problem I saw. But that's the whole process from prop step to funded to payouts. And this is with Top Step. We do have that 20% off link below that you can grab. That should help you out, at least save some money on your first account. But this is a great journey. And so the next video, we'll talk about how to get set up on the platform, how to integrate it into my favorite one to use, and how to start trading. All right, we're going to talk about getting started now. So how to set up without a prop firm, just trading your own money, how to set up that. And then eventually we'll talk about the prop firm setups with Top Step, Quant Tower, and Tradingview. So if you do want that 20% off Top Step, just click the link below. But first things first, Tradingview is just the cream of the crop, one of the best trading platforms out there. And all you have to do is just log in and then type in the futures product you want. They're typically / and then you could do like NQ, that would be the NASDAQ ones. And then ES would be /ES, which would be SPY. So right now, futures look like they're dropping. And if you were wanting to short this, you would go to Trade, All Active Trader, and setting up Thinkorswim is another tutorial which you could find on my YouTube channel. But you can make more panes, you can fix some stuff, but the goal is you want to get this thing up, which is called Active Trader. So you click this Active Trader button, and it should have that section over here that helps you trade off of. So let's buy, and you can see it's going to require actually $18,000 in margin. So the NQ requires a lot more margin. And so we'll try another one. We'll buy there. And I'm not going to get into the details on how to put in an OCO order, how to do all the fancy stuff on Thinkorswim. I'll probably link that video beneath, but you can set up your profit target, your stop loss at the same time. But you can see right here, if I drag this up, I do have an order I'm entered in, and it's a $5 profit. And you can also see that I have another order here I want to get in on. So I could add another one here and try to get in on multiple orders, try to scale into this trade, and maybe play a breakout over this. Who knows? Something simple. We'll show you a strategy to trade later, but there's 3 contracts. So I'm in 3 contracts, and what we'll do for fun, we'll just let this run. But you can see I'm on a sim account. This isn't even my money, but it's $55,000 of buying power. So when you think of futures, you have to understand some products require a lot of margin, and you may not be able to trade them with your account size. So pick the right product according to your account size. What you could do is use the minis. So the MNQ is a micro NASDAQ. And if I click this, it only requires $1,800. So we'll go ahead, we'll just enter this one as well and see which one runs more. You can see at the bottom of my screen, $170 profit. And then this one's at $5 profit. So slightly different there. Let's go back to the NQ. You can see 125 bucks. We'll put some profit orders in just for fun, just to see if they get filled. Not a bad profit. There we go. Boom. So nice profit so far. I'm just teaching how to use the platform, but this should more than pay for any fee on these prop firms. Now, if you don't have, let's say, 55 grand or 2 grand, what could you do with the prop firms? So all you have to do is go to Top Step. It's our preferred platform, and you can use the 20% off link below. But any of these packages, you would just start with that. So the benefit is the more money, we'll have a larger max loss. So you have more wiggle room to be wrong in a trade before getting stopped out. But if you want to trade tighter, not make as much money, have this not cost as much money, the 50K account could be good. So you select your account, we'll go for the middle one. And then from here, it's going to tell you what platform you want to trade on. So it's important that you pick the right one. And they used to integrate with Tradovate, now they don't. So I want to tell you exactly my favorite new integration, the platform I like even better than Tradovate, because there's this huge learning curve to all of these platforms. You can see here, there's a bunch down low, and a lot of these will charge you to even trade fake money, sim money. So it's not fun to pay double. So there's one free platform. It's the top. It's Quant Tower. I like Quant Tower the most. You would pick I understand. Click next, and you purchase this. I'm not going to purchase it right now, but what's going to happen is it's going to take 24, 48 hours to get this account going, and then you're going to download Quant Tower. So just go to their site, Quant Tower, and just download. Real simple. So once you download Quant Tower, you're going to connect your Top Step account. I'll pull up Quant Tower here for you. And I don't have all my stuff up. I hate when this happens. You can see here, you want to click on the top right. There's going to be like Rhythmic, or it's going to have DX feed. You want to click your connection in the top right and just connect to the brokerage you're trading. So Top Step's going to be in the T's. Once you connect to Top Step, just put in your information and log in, and then you should be able to start trading. So I go back, I'll show you what this looks like again. And it's very simple. It's very smooth to use Quant Tower. It's probably got some more functionality, I don't know. But again, I will link a video to the bottom of how to use Quant Tower, because I made a full-on video on all the basics. So we'll do the same thing. We'll type in NQ here, and we'll just get that futures contract rolling. I think it's NQU actually. Don't hit the micros. And you can see we have an indicator, we have candle colors, like it's very customizable to how you like it. And then over here is like your entry and exit tab. So you can buy at the market, buy at the bid, buy at the ask. You can't buy now because the market's closed. It should open up in an hour. But very simple. If you click this mouse button, you can just enter, right click, left click. It could be a stop loss or limit order. And then down here you can have a buy limit or sell limit. So you could trade off your mouse, you could trade off these buttons, and you can trade off a keyboard. So just clicking buttons and getting in and out. Quant Tower, super simple. I don't have this up for you to see exactly, but if you connect it, the connection tab's going to be in the top right. Click DX feed, and then, or Rhythmic, whatever it is, and then just try to find the Top Step section, because that'll be how you get access to it. And this is the most important thing, is just connecting properly. And once your account goes live on Top Step, that's how you can connect it. So that would be the Quant Tower setup. And then lastly, real important, most people are confused by this, but futures, the data is not free on most platforms. It costs money. So if you want to buy the data, you would need to go to Tradingview. Now we're talking about Tradingview's integration. And you're going to have to click your products here. So let's go to, where is it? Tradingview futures data. Where are you? I forgot how I paid for it. All right, so right now you can see my data subscriptions in the bottom. I have my annual subscription right here. That one, I pay the highest tier. It's really helpful. I like this platform. But more importantly, you can add your extra market data in your platform. So you go to your profile, hit settings, account, and billing, and then go to extra data subscriptions. So from there, you want to add this one right here, the CME, CBOT, COMEX, and then NYMEX. This one I pay $5 a month. It just gives me real-time futures data, which allows me to watch like the NQ and watch the ES and check it on Tradingview. I don't trade on Tradingview, but you can. I'll show you that in a second. But all this future stuff is just real time now. So when I'm charting and then I'm putting in the trades, it's all cohesive. If you did want to trade on Tradingview, which you can do with TradeStation, they have futures, interactive brokers, and more importantly, Tradovate. So Tradovate doesn't have the best reviews, doesn't have the best connections sometimes, but they're integrated in a lot of prop firms and you can connect it really easily here. So this would allow you to trade with Tradingview, and then you'll have that real-time data. So some platforms, you'll have that up, and all you have to do to trade on here. So I didn't see this, but next to paper trading, there's this button trade, and this brings up the DOM. And this allows you to place your trades. So if you wanted to buy SPY here, you could take profit, put a stop loss in, same order, and then market's closed. But you can trade off the DOM too, go long and short. This is really helpful. And then you could just place orders, limits, market, or stop. It's not great, but it's okay. What I like is that you can put the orders in with a right click sometimes. So it would be, let's try to put a sell limit in. So you can have this order right here and then put your profit order. You drag that up. Limit order, stop loss, profit zone. And so you have a full-on trade. And it's a beautiful looking platform. It's integrated already into everything we use, and now you can do the futures with it. So you can be very tight with the candles you use, very tight with your limit order, like getting in at the low here, trying to get this to break lower. That'd be $2,000 possible gain, $3,000 loss. Then you could do another one if you want. So put in another order here. And then this one, try to get in here, add your stop loss limit order at the same levels. And you can see 4 grand, 11 grand, or 11,000 or 1,100. So there's the opportunity to put in the OCOs on this platform. And you can put in a lot of complicated orders. It's great. But the only way to use it is with everything I've showed you below. You have only those platforms available. So we log out. All of these ones are available. See all brokers. There's even more. These connect to like crypto brokers too. So Binance, Alpaca. These can trade cryptocurrencies. So that is how you hook it all up. Start trading with prop money or live money or paper money, depending on your risk tolerance. So now that you have your futures understanding, your knowledge, you have your tools, hopefully your prop firm account ready to get set up, you're probably going to be curious how to trade it, where to get in, where to get out, how to get your edge, how to get funded, how to get consistent payouts. Because if you don't understand everything I'm teaching you here, you're going to hit this wall, this frustration, and you're not going to have that consistency. So my goal is to help you be consistent. So again, we'll be talking about candlesticks, trends, reversals, and understanding key levels and everything. But the number one thing I want you to understand is do not trade against trends. If you can try your best to trade with a trend, you're going to make much more money. When I first started trading back in 2016, 2017, I just always would hear on the news how the market was going into a recession, and I could never buy a long option or buy a long play. I did not think the market was going to keep going up because I heard all this fear, uncertainty, and doubt. So I was trading against the trends all the time, and I was always losing money, missing the biggest wins because of that. So please, the one take home right now is don't be always going against trends. If you hear a little birdie saying the market can't keep going higher, well, yes, it can. It always has been. So don't listen to that birdie. Let's jump right into it. Number one, analyzing the candlestick. So I made a presentation on this in the past. We'll just use it. But a candlestick, the basic psychology is a bullish candlestick runs from the low to the high. The price has been bidding up the whole time. People have been agreeing, hey, this is the new price, this is the new price, this is the new price, and it's rising. So this is bullish, and we want to see if the candle runs from the low to the high, and that would create the most bullish scenario. So most bullish scenarios, if you just ran up low to high the whole time frame of the candle. Could be 1 minute, could be 3, could be 5. If you go from the low to the high without pulling back, that's extremely bullish. You don't want to trade against that trend. So what happens here is the wick for this bullish candle is where the sellers would come in and push it down. So typically, like, the candle ran up, and then the sellers at the end of the time frame pushed it down. So the sellers agreed, hey, the price should not be here, and the buyers said, okay, we'll drop it down. This is where we agree the price should be. So if we look at this candle, it tells us the picture of that time frame, and currently, where the buyers and sellers are at in terms of the battle. Same thing for the lower wick. This would be in the scenario where it ran lower and then it ran higher. So the body closed here, opened here, and then closed here. So open, close, but this was the distance it traveled before it closed. So it traveled lower than the open, meaning there's going to be a wick on this candle. So if it goes lower than the open, it makes a wick. Why is this meaningful? Well, if the candle goes down and comes up, that's a buyer reversal. So that's a buyer strength move when you have a wick at the low. So if you see wicks on the tops of the candles, that's seller strength. Wicks on the bottom of the candles, that's buyer strength. And so you're probably wondering, Matt, this candle's got wicks on the top and bottom. So who's winning? And that's a good question, because the candle moved higher, but in the sense of the candle, there's buyers and sellers winning on both ends. The buyers won the battle at the bottom, sellers won the battle at the top. So this is slightly bullish. It's not a great bullish candle. We consider this slightly bullish, but mostly neutral. So this is kind of my chart here for strong candles to weak candles. So in the sense of a bullish move, if the market is going from the low here to the high, that's the best, most bullish candle. And so what typically happens when you go from bullish to bearish is if this move here gets faded, like let's say we ran up this whole move, and let's say the next time we try to do this, we drop back down. And then that wick is going to show. So that move up, part of the move up got faded. It's okay if part of the move higher reverses, as long as for the most part, the majority of the candle is higher, bullish, and large. You get to a problem when the candle becomes a 50-50 candle. So 50% body, 50% wick. That's where it becomes neutral in my mind. So we have bullish, super bullish here, super bearish. We're getting to the point where it's still a bullish candle, but it's not finishing strong. So the chance of continuation is not as likely. So the more wick you have, the more we have a higher and higher chance of a reversal on the next couple candles. So we see this candle here being your most bearish bullish candle. So I say bullish because it has a green body, but it's bearish because it has 75% of the candle being a wick. So when you get to the candle being like 70, 80, 90% of a wick, those are reversal candles. And then here you have neutral. So like I said, the people want battles at the top, they want battles at the bottom. So there's pretty much no winner here. Both sides have won on that same candle. Now let's go over to bearish. This is going to be bearish. I don't know why it says bearish candlestick analysis. So what's different from this compared to the bullish one? So the body here, it opens at the top and it goes lower because they bid down the prices the whole candle. So that would be that move lower. That's why it's red. So the red and green is just based off where the open and close is. The open is here for a bearish candle, and the open is here for a bullish candle. So open, close. And then here, open, close. So we go higher, close, and we go for the bearish candle, lower and close. If the market moved lower on that candle, that's a bearish move. We see the wick at the high, the bulls push it up, but they fell. So they fell, price drops back down. Down here, bears push it down, and then the bulls win. So on this candle, same thing. Bears won here, bulls won here. If they're both winning on both ends of the candle, we consider that a neutral candle. Now, same thing as the last slide. A candle that drops from the low to the high and doesn't make a wick is your best friend. This is your most bullish candle. We see this candle having the highest chance of continuation. Once the candle starts getting buyers stepping in at the end, boom, buyers come in, rises this low, closes here. The wick teaches us that the buyers are starting to control the move in the area. Here, it's a 50-50 candle. It's a very strong move for the buyers to come down here and then come way back up and then retrace half of the move. So drop all the way down, buyers retrace half. Here, buyers retrace 80%. So that's a very bullish candle with a bearish body. You want to look at the wick. That's the most important piece of the candle when it's long. A long wick will give you the highest chance of a reversal. And then here, wick on both ends, that's neutral. So I'll take you through a couple examples and we'll see how this applies to the overall market, and I'll teach you the very aspects of analyzing a trend, understanding reversals, and spotting the reversals. This one, we'll actually call it pullback. So what's the difference between a pullback and a reversal is the point I want to drive home. So here in the markets, we'll go MvG, and we'll just go a clean chart. So where's our strongest candles here? So those candles have the highest chance of continuation. So that's my strongest candle, I'd say, that yellow candle. Huge run, closes at the highs, doesn't pull back much more. Next candle's up, up, up. So very strong candle with continuation. Where's my other strong bullish candle? Right here. Next candle runs higher. Next candle runs higher. That's a strong candle. That's a strong candle. What happens after this blue candle? We run lower. So we're looking for the highest chance of continuation. So I want to know the next candle's probability of direction. And so I'm giving you the opportunity to guess the market and be on the right side of your projections. There, strongest bullish candle, next one, and then next one. There's 3 back to back to back. Then over here, we start to get those bearish candles. What I want to point out is this bearish candle has a wick. You know, we're not afraid of the wick. we just want to know relative to the body size, what percentage we're looking at. If it is a 50% wick to body, not a strong continuation opportunity. But this one looks like if the body's up here, wick's down here, let's call it like 90% of the candles of body, 10% is a wick. So we have a high chance of continuation, which is what happens down there. To the T. Here, what's that? That is our massive wick to body candle. So wick, if a wick is at the high, if it's up, this is a reversal. This is not a reversal, but this is in the trend, but this is a dropping opportunity. And if we go to the slideshow, that's the exact candle that we already considered it super bearish. So we recognized our best candles in front of you, and these have presented themselves profitable trades just on this 1 day of price action. So that candle showed up, and that's our favorite candle. The long, strong candles showed up. Those are our favorite candles. So can we spot a blue hammer right here? So this is interesting right there. I'll zoom in. This one, run up. That's our strongest bullish candle. And then here's our strongest bearish bullish candle. This is a very strong wick to body ratio with the wick pointing down, which means the buying pressure's up. So we recognized this candle inside a bullish candle. So that's double bullish confirmation in my opinion. And then the next candle, big wick to body ratio, it does not surpass this wick for 6 candles. So this is definitely a toppy move. Wasn't a big reversal, but it definitely indicated that the move was less likely to happen higher. So all I'm trying to help you see is a candlestick and say, hey, Matt said this candlestick is your best bullish continuation candlestick, or this one's your best reversal one. So I want you to be able just to know the basics. Know this candle and know this candle. Those two are your most important. This one and this one. This is bearish, this is bullish. This is bearish, this is bullish. Now the goal is to apply this to trends, because if you trade the trends, you have the highest chance of making money. You really don't want to just take those candles I showed you and blindly trade them whenever they show up. You're better off waiting for them at a key place. At the end of this whole class, free course, I'm going to tell you the best futures strategy to get funded, a real simple one. But let me show you exactly trend analysis. So number one, we want to go over highs and lows. So it's the key to understanding a trend. If you don't know your highs and lows, you don't know your trend. So a bullish trend is going to be new highs and new lows. So this is obviously bullish trend. We're going higher. Here's your low. Here's your, let's say, high, low. And the market always staircases. So let's see, just draw them all. And you always want to make new highs. And you always want to make new higher lows. So it won't make much sense if we just look at the candlesticks like this. We want to kind of isolate this line. So this line is going to help us see the actual structure of the market. So what we want to see is your high and your low always being surpassed with a new high and a new higher low. So here's your high. We'll make the highs different colors here. So a new high will be, let's say, green and green. Perfect. And then our lows will be here. So a bullish market will not touch this low again. So this is already considered a bullish trend because we made a new higher low. Same thing here. Once you saw this thing make a new high, you know this is a confirmed bullish trend. So you really only need 2 pieces of data to understand the trend. So for the most part, this low here, this is a low that's most important to understand, because once you make a higher low, you could just know automatically this is a bullish trend, and that's your earliest indication it is. So bullish trend starts there, and I'll just, and then what we want to do is just keep marking everything. So new high, new higher low, and then new high. You get the picture. We'll keep marking. New, this one's interesting. I'm going to mark that one as red because it doesn't make a new high. And then new high, and then so on and so forth here. So when anything makes a new higher low, we're going to keep it yellow. I don't know if I can. Okay, so what you notice right here is that these lows, 1, 2, 3, these are equal lows. So an equal low is not going to be a confirmed trend or continuation. This is where we start to get into a possible reversal opportunity. So we want to always know that if you can't make a new higher low, you're at risk at having a reversal and having no continuation. So same thing here. This is a lower high, and then this is equal lows. So this is the area here that I would be nervous to look for continuation, to enter a trade on. But I know from here, we're going to get either a new trend or a reverse trend. As you can see, new highs and new higher lows got put in. So that is your trend, that trend continuation. But from this beginning, this is a perfect trend. And it will make more sense if you take the line off like this and look at the line only. So this line, that's perfect bullishness until here. Failure to make new higher lows, failure to make new highs. This is your consolidation that would worry you. So from there, I'd be cautious to go long and buy in, especially when we didn't make a new high. So the market will typically reverse on lower highs. So I'm going to show you one more area here. This is going to be your bearish trend, and you want to know the characteristics of this. So bearish trends are going to be down, and then this is what we call a lower high, new low, lower high, new low, and then this is where it gets interesting there. Lower high, and then new low, equal high, and then this is the higher low. So that's your reversal, and then new high. So here's reversing, and I'll drag this up. We'll isolate this line and study this. So right here, this is yellow. This portion is yellow because this is reversing opportunity. We made that equal high. So here's a high, equal high, reversing opportunity. Over here, this is where we made your higher low. And this is this is when you start to have high conviction that the trend is reversed. So the higher low is like your first indication. And then once you print the new highs, basically once you break through here, this is when it starts going bullish, confirmed bullish. So let's make this green. This is that exact reversal. But from this move here, this is all bearish structure. And now let's start to talk about that analysis one more time. So we'll make our highs, we'll make them green because they're going to be within the trend again. The trend is our friend. So that's a lower high. That is a bullish confirmed trend. or bearish trend, lower high, lower high, lower high. Here is your new low and then new low. So whenever you make new lows, that's trend confirmation too. This doesn't tell you where to get in. I haven't even got into that yet. I just want you to understand how to recognize a dang trend. If you can't do this, it won't make any sense for you to plan entries, because we're planning our entries around these key levels. So you can see here, just like I showed you with the previous chart, once you make an equal high or equal low, you want to always approach that with caution. That's going to be your reversal possibility. And then here's where it gets bad. This is where you make a higher low. So if the trend is made up of new lows, this is where the trend can die. And then here you make that new high rally when you break this level. But when you see this, all you're looking for in this trend is new entries to have more continuation down. And where that is, we'll talk about later, but this is bearish structure. And so if you can see that, recognize it, that's the key. Other than that, there's neutral price action, consolidation, that is just, for the most part, just equal lows and then equal highs, and then you just play a breakout from there. That's relatively easy to spot. I mean, you know, here's a low, and then here's a low, and then here's a low. I mean, those are all equal, so it's a pretty easy trend here. And then there's a high, and then there's a semi-high or high, but there's a semi-high or high. But for the most part, there's no trend. The trend is made up when the lows and the highs come together, and you end up getting higher highs and higher lows, or lower lows and lower highs. So now the key is understanding a pullback and spotting a reversal. So what's the difference between a pullback and a reversal? Very important when we go through this, because I really want you to crush your trading, and if you don't understand this, it's going to hold you back for so long. So like I showed you, when you have this trend here, what you want to do is mark your, so you mark your, like here, this is going to be your, this is going to be your higher, your lower high. I'll just park this up and show you again. It'd be better not to look at the candlesticks, honestly. So here is your lower high. So if you mark this as your high, it's the highest point of the trade and trend. This is a lower high. That's pretty obvious. So you want to be entering there or better. So you want to be in the trades around that point. But more importantly, if you don't pass this area, it's not a reversal. So this is your key area to know your reversals. And I'll show you what that looks like. But every time you're in a trend, you just want to keep that trend continuation. So new lows, new lower highs. The minute you stop doing that, that's when the reversal happens. But the reversal in my mind never fully occurs until you break through, if it's a bearish trend, this level. And you can see here on the trade, this level, and you can just drag this down as it goes, because this is the high, the previous high. So if you make a new high, you go over this, that would be the start of a bullish trend. And so this bearish trend would be over. And you can see at the bottom here, that is your last level. So a pullback will come to this level. You'll enter around these points. You might even get close, you might miss it, but a reversal is going to go through it. So let me show you that in depth more. Because this happens right down at the bottom. And this is the key. So number one, know your trend. Makes no sense to plan all this stuff if you don't know it. So here's your high, here's your new high. This high here, if this gets violated, that is where the trend becomes a reverse, or pullbacks can become reversals. So here's your pullback area. So we come up to it, and then we go through it. So this is the high, the prior high, and then you have your prior low. So these are the most recent highs and lows. If this high gets violated, there's a reverse trend opportunity, which it does. It blasts right through, and that's how it's a reversal. So reversals go through the prior high for the bear trends to bull trends, and then go through the prior low from bull trends to bear trends. So right here, I'll show you this example too. If we look at this uptrend, make sure. So here's your prior low. Do we go through this? No, we make a new low. Do we go through this? No, we make a new low. Do we go through this? Slightly. Couple candles just wick under. Wicks don't count. You need the bodies to close under. Do we go under that? Not really. Do we go under this? Not really. So what is this here? This is a pullback. This is not a reversal. It's at your key prior low, and it does not get violated. So we want to buy in here, we want to buy in here, and that's a strategy we'll talk about on the next video. So let's just keep walking through this. When does this trend reverse? So here's your low, your new low's right here, and then you could consider this guy up there even your new low. So when does this reverse? We pull back to it, break the low, go right through it. That makes a new low. So if this is your low, we consider this a low. If you do, when you break through it, that's where the reversal happens. So this area was prime time learning for what the pullback is. It's where your prior low supports, and this is prime time for where your prior low breaks, and then that's where the reversal happens. So if you can recognize all of those things, that's the basics of technical analysis. You don't need anything more. You don't need an indicator. You don't need oscillators. You just need to understand your lows and your highs, your trends, your pullbacks, and your reversals. And this is all going to come together in this trading strategy we drop on the next video. This is the missing puzzle piece. This is going to help traders out whether you're trading options, stocks, crypto. This is a strategy that is my favorite, best, most consistent, most reliable one out there. And on this page, you might see an apply now button. It may be on the page or may not be on the page. But what we do is we're going to be hosting Futures Masterminds, which is a small 3-week boot camp that we promise you will get funded, or if you don't, we'll continue to work with you. So if you go through this course, if you go through this strategy I'm about to show you and you're still confused, you don't feel like you have the knowledge and you need that extra help, that extra mentorship to get funded, apply now. There's limited spots. We don't offer this many times during the year, and it's a huge opportunity for traders. So let's get right into the strategy and teach you exactly what to look for and how to trade it, because it's definitely great on all time frames, all assets. But if you're trading futures, there's very specific times of the day, time frames, and risk rewards we want to look for. So this is the #1 strategy to get funded. I've been trading these futures for almost 3 months, and this one is my favorite, most reliable one. So we'll teach you today the strategy, the overview, the ins and outs, the exact zones we look to enter long and short on, and then where we put our profit and stop losses and how do we manage them throughout the trade. This is a full trading strategy, and we try to keep it as simple as possible. So number one, here is the strategy overview. So what we're looking for is the 5-minute time frame, and we want to be trading the NQ or the mini NQ, which is 1/10 of the possible profits. And so we're looking for 3-to-1 risk to rewards, and we're looking to buy 3 contracts. The time of day to trade is the first 90 minutes, first 2 hours-ish, and then the last 2 hours of the actual market. So we don't want to trade anything outside those hours, or else you're not going to see the strategy work as well. So let's dive into the time frame component of it. So the reason I say 5-minute is because it works the best for us. And I'll take my face off. But you could be using the 3-minute or the 1-minute. The goal is for you to succeed on the best time frame, and then when you get comfortable and confident, you can play against the other time frames that may offer less profit and maybe offer less profitable trades. So you're going to struggle more when you scale down time frames. So we always recommend new traders starting on the 5-minute. So if you go beneath that, the reason why it's tough is because it just offers the lower profits and increases the chance of losing trades, which plain and simple is more losers and less profit. So it's less opportunity for you and less opportunity to get funded. So if you're just curious on how to set up the time frames, you go to Tradingview, click the button, and click the 5-minute chart. Real simple. 5-minute chart is where we're going to be doing everything. Next up, risk to reward. And then this is important to understand because there's many options out there, and I'll even show you kind of what I have developed, which you'll be able to download in this slideshow. This is just a list of, like, if you were on a $50,000 account with Top Step and you were trading like the NQ, I'll just go back to here. You could be trading the minis or the regular NQ, and you'd have your risk to rewards listed. So this is going to be a full breakdown of, like, if you took one contract, 2, 3, 4, 5, and then if you looked for like a 10-point move and you had a 2-to-1. So if you look for 2-to-1s with 10-point moves, you're risking 5 points down. So it would help you kind of gauge how much money you could make, and then how much money you'd risk, and then how many trades till you hit your drawdown, how many trades till you hit your daily goal. So this is kind of a cheat sheet. We're going to list a lot more, but at this point, we're just listing 2-to-1s and 3-to-1s with 5 contracts because that's the kind of the max we see before it gets a little too crazy. But what I did on the slideshow is I just broke down the most popular ones from my sheet where we're searching for $1,000. I think $1,000 on a trade is very reasonable, and it's a great goal, and it's attainable during those market hours I showed you. And more importantly, when you hit $1,000, you're not going over like a daily limit because they want to see consistency with the prop firms. So if you make like 10K in a day, some prop firms won't even pay you out unless that's like 30% of your total gains for when you want to get paid out. So you don't want to shoot for too much. You don't want to shoot for too little. $1,000 on pretty much any account size is decent. So what that looks like is if you took 5 contracts with a 2-to-1, you would be looking for 10 points of profit, 5 points of a stop loss, and that's on the NQ. So the profit there would be $1,000 with those 5 contracts. You're basically making $200 a contract, and then your loss is going to be $100 down a contract. So the other risk to reward that could be good is if you had that same setup, a 2-to-1, but you had a wider profit. Let's say you're looking for a 30-point profit. That's where you could use less contracts and still hit that $1,000 gain. And so your stop loss is going to be further apart at this point. It's going to be 15 down. So you have a wider stop and a wider profit, but you still have a 2-to-1. So you don't have to use as many contracts with this one. And that's where you shoot for like $1,200 and your stop's at $600. The other favorite one is like a 3-to-1, so a wider risk to reward. You could be shooting for, let's say, 20 points, and then you would risk 7 down, and then that would give you 400 to 1200. So that's a 3-to-1, and this allows you to have a winning trade, pay for more losing trades. So it's important that you have better risk to reward, because 2-to-1s, a winning trade only pays for 2 losers, and sometimes if you hit too many losers in a row, you get too close to your drawdown. So a 3-to-1 will help you kind of avoid that. But let's say you want to trade the minis, you want to have more contracts. So with the minis, you could use 10 to 15 contracts, and with the proper risk to reward, let's say like 2-to-1 or 3-to-1, you could hunt bigger moves at that point, because the minis you can't make as much with like a 10-point move or a 20-point move. So with the minis, we're looking for major moves like 40 points and 50 points. And so that allows us to hit that $1,000 potential. So you'd only be using the minis if you want to have a big move in the market. So if you're hunting like the biggest move and you want to have your stop loss the furthest away, the stop's here 25 points down and then 13 points down, which is pretty similar to this one, the 15, but we have 25 here. And so let me give you an example of what that looks like and how we can apply it to like a trade in the market. So right here, we have a major move where the market was basing today. So we had a great trend. We ran 100 points. So if you're curious like how much that is, 10 points is $200. So 100 would be like $2,000 a contract. So if you had 10 contracts, that's 20 grand. 5 contracts is 10 grand. It's a big deal. But let's say you were trying to enter at consolidation, and then you entered like somewhere in here. So if you were using the risk to rewards we showed you, I'll show you exactly. If you were looking for, this is 10 points down. 10 points down, let's say a 2-to-1 is going to be 20 points up. So if you were playing a 2-to-1, you're getting in here at the support and you're shooting for, let's say, the highs. That would allow you to hit 20 points up, you risk 10. So if I know that is my potential just in the trade, like you can look at this trade and say, yeah, the highs are 20, 30 points away from the lows. So you really wouldn't want to shoot for more than that because of the strategy we'll teach you. But you would be in this boat right here. So you could use 3 contracts in this trade if you're shooting for 20 points. And so you could have a 7-point drawdown if you're having a 3-to-1, or a 10-point drawdown if you're having a 2-to-1. So I go back to the chart here, and you can see I can have a 10-point drawdown, and that's where my stop would be. So this is a pretty decent trade. If you get in somewhere in these wicks, you could put your stop under the low, and if the trade works out, if the trend is intact, you should be good here and hit your 20-pointer. So if you want to hit the high of the wick, that would be 30 points. So you could do that same exact strategy. That's a 3-to-1. And so a 3-to-1, you could do 30 points for 10, or you could do a 2-to-1 with 30 points and 15. So that would be, 15 would be down here. So all of those risk to rewards, you could just play this consolidation here. So back into this low and high. But what I'm showing you with the minis is a bigger, you're looking for bigger moves, and you're looking for like further away profit zones on, you're looking for those on higher time frames. So let me show you exactly what that looks like. We'll use the 50 and 25 pointer, and that's where you're just trying to hit a bigger move. 50 points is a lot in the markets. Today's kind of wild, but if you go to like the 2-hour chart, if you marked your high from like the past, you want to hunt this in the future. So let's say like that top candle, and I'll just drop this down for you. This top candle we want to hunt in the future as our profit target. So wherever we were in the middle of this move, like that's where we want to head to. So knowing that, let's say we were in this consolidation here, but you wanted to hunt this next zone up here. So you go to your long position, let's say you enter in this chop, and you want a 50 pointer. So up here's 80 points till the profit zone, and then 50 points would be, I would say, kind of like in the middle of the zone. So this allows you to have a 25 point drawdown, like there. So let's say you enter not at the low, but in the middle of the chop here, or you enter at the breakout. You could put your stop under the low here. You could enter at the breakout, stops under the low, and target that 50 pointer. And still have good risk to reward, still have potential to not get stopped out, and put it under this consolidation. So hopefully I'm not losing you. Hopefully you understand that like bigger moves, you can put your stops further away. And so you can be a little creative with how many contracts you use and which contracts or which tickers you use. And the goal is like if the bigger moves, the MNQ will be way more helpful. Because like this move here, you could have gotten late, played this late, and then just had a really large stop. You could even gone 30 points down and then looked for like 60 points up, which you would have hit that 60 pointer. So as long as you have like wider like trend days and highly volatile days, you can have wider stops and shoot for bigger moves. But not all days will allow this. Like a 60 point move was not possible the prior day. I have a lot of crazy stuff going on here. Where is it? So that's from yesterday. I mean, this is like after hours, so there's really not much movement here. Like this is 30 points up. So that's why we don't trade like the middle of the night. But just yesterday in the markets, you can see we went from 60 to 80. So that was a 130 point move there. But towards the end of the day here, we went from 50 to 90. So that was about 40 points. So towards the end of the day, the range got a lot smaller. And so you can't hit big moves every single day. But on a really strong day, voluminous day, volatile day, you can hit some very large moves. And so that's where you can use wide stops and use like one contract on the NQ, which we really don't want to do. Or we can use multiple contracts on the MNQ. So the MNQ is great for those big moves because you can see here like we can barely even use more than 2 contracts in some cases for the NQ if we just hunt like a 30 pointer with 2 contracts. It's just not a huge move. Today we've seen 300 points up on the NQ. So 30 points is like nothing. You could get stopped out in seconds. So on these trending days, you want to use wider profit zones and stop losses. On tighter days, you would scale down to maybe the NQ and use tighter profit zones, tighter stop losses. So that's how we relate the profit and risk to reward to the days. And I think it's important to understand those differences. So now let's move down to the next part, the contracts. So the point of multiple contracts is letting winners run and then staggering your stop losses and profit zones. So sometimes, like let's say you're trading and let's say right here, for example, this is the high. If you put you got in at the low down here, you bought in, you're looking for the highs to hit. This candle right here misses the highs by just a little bit. Like that is missed it by, let's say, 4 points. So if you stagger your orders, you might have been able to get out a little bit of profit here, and you might have missed your other orders up here. But staggering your orders allows you to hit some profit if it goes short, and if it goes long, you get to let some run. So let's say in this other example, you took some profit here and then it ran through. So if you let's say 1 contract run, or let's say 5 contracts run, 2 contracts run, you can take advantage of these trending days. So, trending days, you want to let more run. Consolidation days, you want to let more be taken off. But just this move here, like if you let it run over your profit zone, this is going to be a 60 pointer on futures. So $1,200 a contract. So $1,200 a contract. So if you just had 1 contract run on the NQ, that would be beautiful. And that would be, again, assuming you were entered in here at this low, like you entered in at this like bottoming candle, and then you exited some here, but you let like 1 ride. So you enter here, exit here, you let some ride. If you let some ride on the right days, you have a really good chance of just doubling your profit or tripling your profit. I mean, if you got in earlier in the day, 1 contract would have been up 200 points. So that would have been a $4,000 runner. So let's say you like enter here and then you exit like on this next candle, but you let some run. So if you let some run from here to here, that's $4,000. So that's the potential of great runs on a strong day. And so if you have 5 contracts, you can let more run. You can scale more out. That's probably the best, but we want to start with at least 3. 3 is like the most important for all scalpers. So if you want to take setups with 2 or 1 contracts, it's okay, but you're not going to be able to let some run. You're not going to be able to stagger your orders and get partial fills on a trade. And sometimes you'll miss all the profit because of that. So it's important to just have more and more contracts and stagger those orders. Now let's get into the meat and potatoes of the strategy, which is what we call the power zone. And this is just a fancy word. People call it other stuff on the internet, but it's supply and demand with a twist. You're just playing off large institutions. So a power zone is where we enter our trades. This is going to be a level of resistance, or if we're above the level, it's a level of support. And then if we're at the level, again, resistance. So power zones are zones of resistance and support, but we look at institutional reactions at those. And it's important to know that we're just looking at these levels because they have large reactions and they can have highly profitable trades from them. So the best risk to reward. So you have defined places for like a stop loss, and more importantly, you have huge potential to run a decent amount to the next zone. And so here is the difference between supply and demand and the power zone. So supply and demand is just taking let's say a bottoming candle here, that bottoming candle, and then drawing your zone. So that'd be what we call a demand zone. That is good, but it's not going to get you to hit like 85% win rate. So that zone there, we don't want to trade off the old-fashioned supply and demand. We want to trade off like this candle here. And we'll talk about the difference between this candle and this candle, because this is what we consider a power zone, and this is what we consider just a regular supply and demand zone. So we want to take supply and demand, give it some steroids here. So criteria number one to recognize these zones is you want to have the candle that fails to make a new high. So if you're trending up, the candle will fail when it breaches the prior highs and then it comes back down. That's criteria number one. So any failure to move higher or lower will start us to look for this zone. We need to have this happen next though. If you have these two things happen, you have your most quality zones. So number two is that the candle after the failure candle produces a fair value gap, or just a gap between the first and third candle. So the first candle is here. We look at the low of this candle, and then the third candle is here. We look at the high of this candle. If the high and the low don't touch, they produce a gap. And the gap is strength. The gap is the power that we know that zone is going to have that same reaction in the future. It's going to have power in the future in a large move. So it's important to know that those two things, once found, will initiate the zone, and you just have to wait for it. So again, here's what we look for. You have to hit the failed high and then the gap. So that gap forms in the failed high, and then you draw your zone based off either the candle body or the candle body low plus the wick. So you can go all the way up to the wick if you want. I like the candle body though, so that's good enough for me. So when both those happen, you draw your zone, and then we're just going to look for price to move into it in the future. So trading the zone, really simple. You want to wait for a candle to close and respect the zone. Close and respect. Number two, you want to enter at the close of the second or third candle. And so when I say close, all I mean is that the candle at a 5-minute chart has 5 minutes before the next candle appears. So you want to wait for the first candle to finish the full 5 minutes. We need to make sure the zone's respected. If it goes through the zone, it's still an opportunity to trade and profit, but it's a different strategy then. So once it closes and respects the zone, the second candle we want to enter with like 30 seconds on the candle, or let's say like 15 seconds. Or you do that for the third one. The second or third candle you want to enter towards the end of the close. So you can enter like 5 seconds to go or 10 seconds to go. And let me show you exactly what I mean. So first off, let's go through finding these candles. So we'll just show you how to find a power zone first. So number one, we want to look for a candle that fails to move higher, fails to move lower. So first thing first, here's the candle high that failed. We went up and we failed because we couldn't hold it. We couldn't make a new high. So this could be a power zone. So that's criteria number one. But criteria number two did not get met. We did not produce a gap between the first and third candle here. So this is not a valid power zone. So we don't want to trade off that in the future. Next one. Down here looks like a pretty good bottoming candle. So this one, do we make a new low? And we don't. This one actually has a low on the prior candle that is lower. So this does not produce a power zone. While it could be supportive, we're only showing you the very best candles to trade off of. In the next one here, we make a low that fails. So this meets criteria number one. These three candles have a low. This one goes under and fails. But criteria number two is not met. We don't have a powerful move after. So we don't want to put that one up either, unfortunately. Going down here, that candle satisfies our objective, and so does this one. I'll go off this one more importantly. This one's kind of easier to look at. So this candle in the middle, this one creates a low compared to the prior candle that fails. We come through the low and then don't go lower, we pop back over. And more importantly, the next candle produces a gap between the first and the third. So this is the gap. And this is a place that the market typically will move back into the fair value gap. So we have a strong move and we have a failed low. So that is our power zone for the future right here. So what you could do is draw the zone. You could either go from the body high to the body low, or you could go from the body high to the bottom of the wick, or you could go the whole candle. It's up to you. There's no right way to do that. But more importantly, you just want to see the candles that come into this zone hold the zone. If we go through it, that's where you want to play the failed opportunity. So that's how I draw the zone right there. And that was a valid one. The other ones were not valid. Hopefully you understand the reasoning behind that. And so I don't have an example of entering in this zone. We'll show you on the next couple slides. So here is trading the zone. And this is the exact candle I think we drew from the past. And you can see here, let's get that perfect. This is a failed high that produces a large move after with a gap. So that is the zone we want to play in the future as resistance. So here's the checklist. The first candle needs to close and respect the zone. When I say respect, I mean it has to stay underneath the zone. If it goes over, it's okay. If it's a wick, the body needs to stay under. So that 5-minute candle closes beneath the zone, which is perfect. Next, the second candle also wicks out and closes under the zone. But the first 2 to 3 minutes of this candle, we were probably over the zone and it looked like it was going to break out. So that's why we don't buy in the first 2, 3, even 4 minutes. If you're doing that, you could have got this to shoot straight through and not respect it. But because we waited, because we were patient, it showed us this sell-off in the last couple of minutes. And then this has produced a great entry candle. And then the third candle is the best one to enter on if you can. If you can wait to the third one to close under the zone at the end of the candle, that one's great. But sometimes it moves too fast at this candle and you kind of miss it and you have worse risk to reward because of it. So I like to enter multiple contracts as the trade goes sideways at the second and third candle. So you can enter on the second one. It's better to enter on the third if you can. And so once we have those trades in, we just have to manage it properly with the stop and profit zone. And there's multiple ways to do that, which we'll talk about. But the first thing I want to go through is just going through a failed zone, because sometimes that level you drew, for whatever reason, there's volume, there's news, it just blasts through. And if that happens, you want to do this other strategy. And it's the same strategy, but you're just playing for continuation and playing the opposite of the zone. So if you see the candle blow through, don't worry, it's still a trade that you can take. So what we're doing is waiting for the candle to hold above if we blasted through the zone on the next 2 and 3. Next 2, 3 candles. We enter on 2 and 3 if those close above towards the end of the candle. And so we want to play the push through as the zone with support. And then if we have let's say a support zone, a support power zone, if it blows through that, we want to play the resistance retest. And what this looks like in an example form is if we have a failed zone here is a candle makes a high that fails, next candle produces a large move down. This has a resistance here that we blew through. This candle went right to the top and we would say closed above the zone. So this is why we wait for the candle to close. If you enter on the first candle, it might not even respect the zone, and the trade might be to push through the zone. So the trade opportunity might be completely different because of what happens in that first candle. So waiting for that to close is the most important. So this one closes, you could say at the zone or over the zone. It's kind of mixed, but the very next candles close above. So that's the opportunity now. So we want to look for continuation. So we want to buy in. It's kind of a cautionary thing to buy in on the second one, but you could buy partially on the second towards the end, like the last 30 seconds. Make sure it's above the zone. Make sure it's 30 seconds to go, and then you can start buying in on the third candle as well. So the third candle you can buy in the last 30 seconds, but you could also buy in a little bit earlier on that one because that's the one it typically runs. But make sure that one closes and stays above the zone. If you break through the zone, you're going to have to take a stop, and you're going to have to get ready to hit a loser. So that's a failed zone opportunity, and we can show you some examples of that later. But I want to go through the most important thing, which is fresh versus stale. So the reason the zones will work or not work is because they've been tapped into in the past. So sometimes I'll play a zone that has already been tapped into and the trade won't work. And it's because that fresh zones are much better to trade off of. And a fresh zone is like the one up high where we have that the candle makes a new high. We have a gap on the next couple, it looks like, and then we mark that high candle. So if we look over to the right, we don't see anything touching this zone. It's a fresh zone. So the first reaction in any zone is the highest opportunity to profit. You know, the one that gives you the best opportunity to make money. And because this one's fresh, you know, we really want to attack that in the future with more conviction. Down here is what we call a stale zone. This candle down here makes a new low, fails, produces a gap. So that's our zone. But then we tap into it right here. So this already taps into it and supports. It pretty much runs next couple candles, but that zone is now stale. If we hit this zone in the future again, it's not going to be a great zone to play off of. So once it hits it once, we don't really want to play with full conviction or really ever. You only want to play your fresh zones and just be super patient for those to hit. So fresh is where it hasn't entered in yet, and then stale is where it's already popped in. And some other technical reasons why is because the market typically gives out on levels on the third touch. So third touch higher breaks through, third touch lower breaks down. Third touches are just your lethal times for levels to just crap out. So now let's just talk about management of the trade with profit and stop losses, because this is super important and there's a lot of strategies that's going to help you succeed long term with this. And number one is the profit zone, and this is where you want to put it at the prior high or low. And a reason why is because double tops, double bottoms have great reactions all the time. And sometimes it just never blows through that level because there's just such strong sellers or buyers, because it could be a power zone. So the prior high or low, you just want to scale a little or a lot dependent on the day. Like if it's a choppy day, scale it all. If it's a trending day, scale a little. Like we saw today in the markets, like if the market's moving 300 points, if you scale a little, those last contracts can pay for your yearly salary. You know, we saw, like I said, $4,000 a contract from the morning. So if you had 10 contracts, it's 40 grand, and you'd be leaving a lot of money on the table taking smaller moves on those days. Recognizing those days is a whole other lesson that we're not going to go into today, but yeah, you'll understand it the more you trade. And then the stop loss, we're going to put our stop loss at the lower high. So if you're playing off resistance, you're putting it at the wick. So the wick, the mid wick, or the body, of the highest candle or the lowest candle. So we'll talk about that in a second, but there's multiple places to put the stop, and the more contracts you have, the more you can stagger those. And some of them are tighter, some of them are looser, and the reason is some might get stopped out on a false move, and then the others might still profit in your favor. So it's okay to stagger them. And more importantly, we want to trail our stop as the move happens. So you want to trail some or all of your contracts basically when you hit 30 and 50% of your target. So if you're halfway to your profit zone, you want to really reduce your risk to 0. You don't want to lose money when you're halfway to a profit zone. So you want to make sure the stop loss gets close to break even on most of the contracts. So what does this look like? We see this trade right here. Let's say this is a power zone, which it's really not. I enter at this and I'm looking for the move up to the highs. So if you enter as support, you put your stop loss at the wick. So you can see my stop is in red. It's at the wick. And I just look to hit the highs, which is going to be my profit zone. And so this is a typical trade with good risk to reward. And you can see it's up $360 just on this partial move here. So this is a classic, wick stop to the highs profit zone play. And it gets a little bit more complex and advanced. Let me explain. So when you have multiple orders, you can really stagger those bad boys or bad girls, depending on the gender of anyone listening. But profit and stop loss here. We're talking about mostly stop loss in this one, so we'll just call it stop loss. But you could do the same thing with a profit zone. And when I get into a trade, I just want to make sure I manage my risk. So I want to make sure I put the stop losses in ASAP. You could do this automatically. You could do this with OCO orders, so the stop and profit zone go in the same time. But there's multiple areas to put this, and there's no right area. But the idea is you could also stagger these orders like I did here. And so you could have you could use all the areas at the same time, which I've done in the past. And it works out. I like it better that way. But basically, you can use the body. So let's say you're entering long here. You're going long and you're already in. You put one stop loss at the body. You put one stop loss at the middle of the wick. And you put one stop loss at the end of the wick. And then there's the option to go slightly outside the wick. Because sometimes the market will hunt stop losses. And it'll go just to the wick. It'll just hunt all the wick orders, and then it won't go beneath it. We see that happen a lot. And sometimes it goes straight through down, takes all the orders. So sometimes you'll get away with maybe one gets stopped out, the rest are good. Maybe none get stopped out, but sometimes they all get stopped out. So staggering them can be beneficial, and as well as staggering your profit orders. And so this is a full advanced strategy here, based off what we talked about. So let's say we enter a resistance play, we take a high here and we start to make a fair value gap. And so this is middle of the trade developing. But this is just something I threw up just to show you. So we're up $220 on this trade, and we put our stop loss, one stop loss at the bodies, one stop loss at the wick, and then one stop loss above the wick. So one's super tight, one's a decently further away, and then one's very far away, where if it hits this one, we know we're just in the wrong trade, the wrong trend. And then you could do the same exact thing for your profit orders. So one of them could be, let's say, at one low here, you take the low of this wick, you take the low of this body, you take the low of this wick. You kind of just want to hunt the low. So whenever you're trading the strategy we're going to teach you, you just want to hit the lows or hit the highs. But if you stagger the orders, you can at least get filled on partials if it goes there but doesn't go the exact length of the move you need. So I like staggering them for those reasons. And you can see here I'm in 3 contracts. I could also just let one ride. If this is a strong trend day, I could let one ride or 2 ride and just manage my risk more aggressively and just see how far it can go. And so you can drag these orders down as the trade goes. And that's where if it moves halfway down, you move your stops down with it. So your stop losses should theoretically be moved to break even when you hit that 50% down. And so that's the full strategy. I'm going to give you some examples here, show you some live market stuff, but this is the strategy in a nutshell. So only trade the first 90 minutes or the last 90 minutes. Where we're looking for the candle to make a high or low and fail. That's going to be your failure candle. And then the next candle makes a strong move. That's where we draw the zone. That's where the power zone becomes a thing. And then what you do is you wait for the move to come in the zone again, wait for the candle to close once and respect the zone, and then you enter on the second or third candles at the close. You buy 3 to 5 contracts, stop loss under the wick, in the wick, or at the body. So there's multiple places to put the stop. And you could put it outside the wick as well, which is a very further stop. So profit zones, we're just going to hunt the prior high and low. And then if you want to let some run, you can, if you have a trending day. You want to move your stop as the trade goes. So if you hit 30% of your profit zone, you want to raise the stop. If 50%, you want to raise it to hopefully break even. So let's show you. All right, so we just hit a power zone on the 5 minute, and we'll try to trade this to the upside. And so we have our first candle in, and we'll just try to teach how to go about entering and managing. So you can see this candle made a new low, had a strong move, and had a pretty big gap. So this is a power zone, and we're first candle in. We got 2 minutes to go. You can see the timer down there, 2 minutes to go. So we're just going to wait to see if we close above or below the zone. So this would be like a live trade here, and fully live based off our strategy. And we'll be able to see the power of it. And so we'll wait for the next candle to either hold or go through. And we'll trade that. The next candle in the last minute to 90 seconds. So I'll pause the video and we'll wait to see how we finish here. All right, at this point, we have gone under the zone and produced a major wick. So it's like a 15-point wick. We have 2 minutes left on the candle. So I'll start buying in. And then now I have a guaranteed stop loss area that I know had a reaction in the past. So what I want to do is look for the highs to get hit. And what we're going to do at this point is raise our stop as the trade goes. So 50% of the move, raise stop to break even. And then we want to start buying in 2-3 more contracts over the next. So we have 2 minutes on this candle. We'll wait till the next candle to start buying in even more. But we'll try to buy in the last 30 seconds. Again, just make sure it closes strong. Anything can happen. We can flush out real hard last 30 seconds. But this is a great setup here. Great reaction. And we have a very strong day. We're going with the trend of the day, which is nice too. So we'll see how much we can get a pullback on. But it's always tough when the trade moves this aggressively against you or with you. We're already up $200 on this trade. So it can be kind of frustrating waiting because you can always miss your opportunity to buy more. And that's where the real money's made, is getting multiple contracts and scaling those properly. But you can see strong candle close, strong wick. This is a very high conviction reversal candle. That gives us the run to the highs opportunity. So we still have about 15 points to go. But if we hit this 78 point, we're going to raise our stop to break even because we don't need to have a loser at this point if it's won this much. So we've got almost 10 points here. So 30 seconds on the candle. We'll see how much we can buy in more. But that's a power zone that is working in our favor. Close one candle in the zone. Second candle is closing and confirming again it's going to hold. So we have a really good chance of hitting the highs on this trade. And so what you're looking for to risk is 10 points down. And you're looking for 20 points up. So that's a 2-to-1. And if I go to my strategy list and look at my risk to rewards, a 2-to-1, if I grab 2 contracts, I can hit $1,200. But I need the 30-point move. So I have about a 20-point move here. So I would probably stick to the 3 contracts. And I need to keep my stop around 7 to 10 points to get a proper risk to reward. So 10 points, 2-to-1. I need 3 contracts. 7 points is 3-to-1. Again, I could use 3 contracts. So may not be able to buy more, which does happen. So if we hit let's say 5 points higher, we'll add to the position, or we'll raise our stop up. All right, so this is the time of the trade where we do hit our stop to break even move. And then if you want to put a more aggressive stop loss in, I put the stops on the low of the candles, so lows, or you could put them at the bodies. So those are some more aggressive stops that ensure you have profit at the end of the day if it comes back. But you can see this one contract's running $300. So I mean, a lot of power in futures if you know what you're doing. And this is beautiful here. A lot of potential to run still. Just didn't get any other contracts. So we should have bought more aggressively on the first candle because the second candle didn't give us a chance to get more. But yeah, great example. This is I just pulled up the screen. This is the first setup I found. And this is live stuff. So hopefully this makes sense. And again, we do have that mentorship for our futures mastermind. So we'll take a couple students, we'll get them funded in 3 weeks. And if we don't, we'll keep working with them. That apply now button should be on the screen here on somewhere in the page for this course. If it's not, we're either not hosting a mastermind or we've filled it out. But if you do want to get funded, if you do want to get mentored to use this strategy, to get daily updates and to get like weekly live streams to teach you and get your trades reviewed, this is a great opportunity for traders. So apply now if you can. Find the link below, and we'd love to have you on the next mastermind. Peace.